Hello, I'm Mark Sobel, U.S. Chair OMFIF. Today, OMFIF is pleased to launch this year's Global Public Investor Report. The publication, now in its 10th edition, has been the cornerstone of OMFIF's research since it was launched in 2013. It goes further than ever before to unpack reserve managers' economic views, investment plans, and internal operations. This year's edition features insights from a survey of 75 central banks with international reserves of close to $5 trillion. These are some of the world's most influential institutions whose firepower and official status can underpin trends in financial markets. In the 10 years of the publication, the role of reserve managers has never been so challenging. They are navigating difficult economic and market conditions amid high inflation, weakening global growth, and financial stability concerns. Geopolitical considerations are becoming increasingly important too, following Western sanctions on Russian foreign assets and ongoing tensions between the U.S. and China. In the meantime, many reserve managers are facing pressure to incorporate sustainability into their investment practices, and as financial markets become more complex, it is increasingly important to improve their collection and management of data. In today's event, following my remarks, we will be joined for some brief remarks by OMFIF's dear friend and colleague, Frank Scheidegg, Global Head of Senior Executive Banking at DZ Bank. Then two of OMFIF's most talented members will guide us. Taylor Pierce, Senior Economist, will share the key findings of the report. And then Nikhil Shagani, Managing Director of Research, will moderate a panel focused on the current challenges facing reserve managers. David Marsh, Chairman and Co-founder of OMFIF, will offer brief concluding remarks. One major discussion in the report is the future of the dollar as a global reserve and financing currency. As a longtime former U.S. official responsible for international monetary and financial policy, I'm going to try and offer some provocative food for thought, better than McDonald's, to spice up the subsequent discussion, and we'll soon see if my views align with the GPI's findings. So my bottom line is that the dollar will remain the world's dominant currency for the foreseeable future, though its role may ease. Many measures put the dollar's international financial role around 60%, including in global foreign exchange reserves, similar to its mid-1990s weight. The euro is roughly 20% of global reserves, sterling and yen 5% each. The RMB is under 3%. Gold purchases are up. Given small markets, only so much Australian and Canadian dollars and Swiss francs can be bought by investors. Dollar dominance reflects the U.S. economy's size, the depth, liquidity, and openness of our capital markets, convertibility, and good property protections. U.S. macro policy, hardly stellar, is often less ugly than others. U.S. banks dominate globally. Financial networks use them and the dollar. Inertia reigns. Why fix it if it ain't broke? The euro area has many of these properties, but the euro's role hasn't grown because of the limited market for euro assets, as distinct from national bonds. Next generation EU is beginning, but it's likely to remain largely a one-off, especially given German attitudes. Capital Markets Union is fledgling. The RMB isn't convertible. Capital controls are extensive. President Xi is rectifying the private sector. China will only hesitantly liberalize, fearing rapid opening would launch huge capital outflow. China isn't likely ready to run trade deficits and corresponding capital account surpluses. China seeks to build its cross-border interbank payment system, but that system is still small. Further, it's unclear an investor receiving RMB in settlement would use them as a store of value. We hear talk of a petro yuan, but the Saudi rial is still pegged to the dollar. Increased fragmentation between East and West has coincided with a marked loss of foreign enthusiasm in investing in China. A digital yuan won't change the picture. Its rationale is to take back the payment system from Alipay and Tencent, nor will it make the Chinese financial system open. So the RMB's global role may likely rise in coming years, especially on increased China-Russian trade to circumvent sanctions, but not significantly. Western action to block Russian central bank and oligarch assets surely got the attention of Chinese and Mideastern officials and funds. Their willingness to hold dollars and euros could be diminished, but US and European capital markets are too big to avoid. If the US avoids overuse of financial sanctions, deploys them multilaterally rather than unilaterally, and steers clear of extraterritorial application, sanctions will be somewhat less concerning to the rest of the world. But this is an important issue. Dollar dominance is a net benefit to the United States, but hardly an exorbitant privilege. Lower interest costs, seniorage, and U.S. agents shielded from foreign exchange risks are pluses. So is the ability to impactfully deploy financial sanctions. But dominance is also associated with persistent trade deficits, currency overvaluation, and some adverse impacts on U.S. jobs and growth. So to wrap up, the biggest challenge to dollar dominance is the United States of America. As I mentioned, dollar dominance results from the characteristics of the U.S. economy, not a declaration from heaven. America's challenge is to preserve those characteristics. If the U.S. abusively uses financial sanctions, closes itself off, runs bad macro policy, and undermines trust in America, the U.S. will shoot itself in the foot. The dollar's role, a messenger of U.S. failings in this scenario, could decline at an accelerated pace. Remember, often the messenger gets shot. However, if America runs sound policies and others open up, boost domestic demand, and pursue responsible policies, dollar dominance would likely gradually ease. The global and U.S. economies might benefit. So now, with that, let me turn the floor over to my good friend from DZ Bank, Frank Scheidegg.
Thank you very much, Mark. Good morning, good afternoon, good evening to the audience, wherever you are at that time and listening to us. Let me underline a couple of things what we just heard from Mark. But first of all, I want to say we have a premiere. It was 1 decade ago, so 10 years ago, when we started the first announcement of the GPI. So congratulations to OMFIF, to David and the whole team. Thank you very much for having us as a partner and supporting these surveys throughout all the years. We are reflecting on figures collected for the calendar year 2022. And I don't want to know exactly what the year 2023 will bring us. But as we have seen, the reduction of these overall amount of 700 billion in total, down from 15.7 trillion to 15 even, is already a roughly 5% decrease. What is the biggest challenge for the future? It depends really very much what kind of central bank you are. But if I take central banks in a classical way, they might face a burden, or some of the governments where the central bank is responsible for monetary stability, even in an extreme phase recapitalization. So what does it mean? It means when you are not capable to have also a decent proportion of your reserves in other asset classes, other like the SSA world, you might come in trouble, because I think if we take Europe, we could expect, to my personal opinion, at least another 3 to 4 hikes. So there's a likelihood that we see a further increase of 75 to 100 basis points. And even we will see then a stopping of these increase from the ECB. Again, on my personal outlook, I do expect a sideline policy before we really have a chance to see the first cut of interest rates. That would mean we should come close to the old corridor, which is between 2 and 2.5% inflation, core inflation. Having said that, other asset classes like equities also peaking at the moment. So I don't know how most of you will see the outlook, but I'm not very bullish on these huge markets either. So, and gold alone will not rock the boat in a positive way. So we will see a lot further pressure on the central bank manager, on the portfolio managers, and that means also for intervention there is probably less capital around for many of them. Having said that, again, I will not draw the picture so negative. I intend to be mostly agree with Mark, except on the euro outlook, at least medium to long term. I have a slightly different view. I think we will see a chance that the euro proportion from 20 regain closer to 25, might be even above. What is the main reason for that? I do see the challenge of the way Europe is giving liquidity in capital markets in general. At the moment, we are banking on 75% loans and classical project finance. But I would say the proportion comes to more or less to equal 50-50. So 50% will be financed through capital markets products over the next years. So that will bring more liquidity, make Europe more attractive, will also have an impact on the euro as a currency. And if Europe is clever enough, and some non-European banks as well, the American banks could be of huge help here, and we will shift more liquidity towards to derivatives, in particular swaps. We might have even also there a second alternative to the remaining most important US dollar and its fixed income markets. But here we'll stop, not steal too much from our other friends and colleagues. Thank you very much for joining us today, Mark. I hand back to you, and looking forward for a fruitful discussion. Thank you.
Thank you, Frank. Excellent remarks. And just to be clear, I don't preclude the euro share rising a bit, especially if Europe develops its capital markets through capital markets union, etc. But in any case, let's turn the floor to Taylor Pierce, senior economist, who's going to share the results of this year's GPI. Taylor, over to you.
Thank you very much, Mark. And thank you also to Frank. Thanks everyone for joining us today. My name is Taylor Pierce. I'm senior economist of OMFIF, and it's a pleasure for me to walk through the 10 key findings of this year's report with you. To start off, I just wanted to give a bit of background about the report. So as Mark mentioned, we were pleased to survey 75 central bank reserves managers this year for the survey. That includes both advanced and emerging economies from across all 7 continents. The total international reserve assets of these institutions total $4.9 trillion US, which is approximately 1/3 of all international reserve assets. In addition to the survey, we also include extensive data and analysis of 171 central banks around the world, ranked by their reserve assets, including some regional breakdowns as well. So be sure to check that out in the report, which will be available to download at the end of this presentation. But for now, I will come to the 10 key findings from our report. The first key finding is that reserve managers have had a tough year. As you can see, also mentioned by Frank, total international reserves fell from their peak at the end of 2021 from $15.7 trillion US to $15 trillion last year. This was due to a combination of valuation effects as well as FX intervention in the face of market volatility. It's important to note that reserves fell in every region around the world, apart from the Middle East and North Africa, and this was mostly due to higher commodity prices last year. But overall, we see an unwillingness, or in some cases, an inability for reserve managers to continue to intervene. So when we look specifically at what is concerning reserve managers this year, we see that stagflation is the primary concern. We asked the reserve managers that we surveyed, what are the 3 most important factors affecting your reserve management operations in the current macro environment? Inflation was about the same share as last year. As you can see here, 85% list inflation as one of their top 3 concerns. And not a single respondent stated that they expect inflation to be reined in to the 2% target or under in the next 2 years, which is quite striking. In addition to inflation, we can see here that 70% list global economic slowdown in their top 3 concerns, which is more than double the share listing this as a top 3 concern in 2022. Additionally, 38% of those we surveyed expect a recession this year. So as you can see here, it's quite a difficult macro environment for reserve managers. And another factor which is included here in the short-term concerns is geopolitics, which has actually fallen as a short-term concern compared to last year. However, we see that over the long term, geopolitics and geopolitical tensions is now the #1 concern among reserves managers. 83% list geopolitics and geopolitical tensions in their top 3 concerns affecting their reserve operations over the next 5 to 10 years, so a longer term time horizon. This is what we saw from some of the survey comments was that reserve managers are particularly worried about US-China tensions and decoupling there, in addition to the fragmentation of trade and capital flows. Other long-term concerns include inflation, which we can see here. Again, not expecting that to be reined in anytime soon. And climate change ranks as #3, but does seem to be taking a bit of a backseat in the face of more acute concerns like inflation and recession. Given this difficult macro picture, the next key finding is that we see that it will be a long road to recover the losses which central banks suffered this year. 80% of the reserve managers which we surveyed experienced losses on their portfolio this year. And as you can see from the pie chart here, around 40% expect that it will take 1 to 2 years to recover these losses. And an additional almost 25%, the gray bar here, expect that it will take 2 to 5 years. So all in all, nearly 2/3 expect that it will take over a year to recover the losses suffered in 2022. This also is in line with another one of our findings that capital preservation was the #1 investment objective of reserve managers this year. We also find that very few are taking on more risk as a strategy to plug some of the gaps from these losses. And this cautious approach is also evident in our asset allocation findings. Traditional reserve assets are in demand this year. So just to explain this chart, the light blue bars indicate the share of survey respondents looking to increase their allocation to the following asset classes, whereas the dark blue bars represent the share looking to decrease, and the gray diamonds are the net share of respondents. We can see that a net 32% are looking to increase their share, their allocation to government bonds, which is by far the most popular asset class here on the top. That's followed by net 20% looking to increase their allocation to quasi-government bonds over the next 12 to 24 months. And this is due to a higher yield in fixed income assets, as well as a flight to safety dynamic, which is also seen here as gold is the 3rd most popular asset class for which reserve managers are looking to increase their allocation to. We also see less demand for equities, asset-backed securities, real estate, and corporate bonds than we have seen in previous years as well. So riskier or alternative assets are not as in demand. And this risk-off sentiment is something we also see in our currency allocation findings. We see this year that reserve managers overall are cautious on the renminbi over the short term. We see here that the share of respondents looking to increase their renminbi holdings has halved, falling to 13% this year from just over 30% last year. When we asked what some of the factors are that might be obstacles to further increasing holdings on renminbi, we see that market transparency and geopolitics are some of the main barriers, which could prevent reserve managers from increasing their renminbi holdings. However, over the long term, we do see that there is higher demand for the renminbi than for any other currency. A net of approximately 40% are looking to increase their allocation to the renminbi. And this shows that the renminbi, despite some short-term challenges, is going to be key for longer-term currency diversification of reserves. So related to this rise in the renminbi over the long term, we also see a gradual and marginal decline in the US dollar as a reserve currency, but we do see that it will still remain the dominant reserve currency. So we asked reserve managers what they expect the share of global reserves will be for the US dollar and the renminbi in 10 years' time. Those estimates are represented here by the dashed lines. And we found that on average, reserve managers expect that the US dollar will fall from the current approximately 60% of global reserves to around 54%. And the renminbi will rise from the current 3% of global reserves to around 6%. So these are increases and decreases respectively, but we do see that the dollar will still remain dominant and increases in the renminbi will be marginal. In the meantime, we also see that the euro will benefit from currency diversification. No other currency over the short term has a higher net demand. So again, the gray bars represent the net share of survey respondents looking to increase their allocation to these currencies. And a net 14% say that they will increase their euro holdings in the next 1 to 2 years. Additionally, 9% are looking to increase their share of the euro over the next 10 years, which is a longer time horizon. So we do see the euro playing a key role in diversification away from the US dollar, especially if the renminbi doesn't seem like a viable alternative. Staying on Europe, but moving now away from our asset allocation and currency findings to our ESG findings. We see that European central banks have the strongest appetite for sustainable assets. And this is across all sustainable asset classes here. As you can see, European central banks are represented by the light blue bars. We see that green bonds have the most interest for, are of the most interest for reserve managers, with overall globally 40% of survey respondents looking to increase their allocation to sustainable assets in the next 2 years. And European central banks, the share is even higher, with 61% looking to increase their share of sustainable assets in the next 2 years. So sustainable assets and investment in ESG assets is definitely an area to watch. We anticipate that there will be much more interest in the future. This isn't going away anytime soon. And there's a lot more data on ESG in the report, so be sure to check that out as well. Moving now to the final key finding, we include a new section in our report this year on data and operating models. We asked reserve managers, what are your main operating challenges? And we found that talent was the main issue, where with 58% of survey respondents reporting recruitment and training as the top operating challenge. We also asked a few questions on external management of reserves, and we found that external managers may be used to fill this gap to some extent, with the vast majority of survey respondents, 74%, reporting to use external managers, and knowledge transfer and access to complex asset classes being the primary reasons why external managers are utilized by reserve managers. So that concludes the findings. And just to wrap up, we find that reserve managers this year are challenged with losses, stagflation, and geopolitics, very pressing concerns over the short term and long term. We see signs of a flight to safer assets, including government bonds and gold. On currency, we see that the US will remain the dominant reserve currency, while the euro may benefit over the short term from diversification strategies. And allocations to the renminbi will rise, but the shift will be small and gradual. That concludes the key findings presentation. Thank you very much for your attention. Please take a moment to download the report via this QR code here. And with that, I will pass it now to my colleague, Nikhil Sangani, for the panel discussion.
Thank you, Taylor, for presenting those findings. I'd like to invite the panelists to turn on their cameras for the next session. So my name is Nikhil Sangani. I'm the Managing Director of Research at OMFIF, and I'm delighted to be joined by a distinguished panel to go through some of the findings that we've just heard. So we have reserve managers from 3 major central banks. We have Julius Jablecki, from a Director of Financial Risk Management at the National Bank of Poland, Shareza Minhat, the Chief Representative at the London office of Bank Negara Malaysia, Kashmir Ibanez Camacho, the Assistant Chief Reserve Management Officer at the Central Bank of the Philippines, and joining these reserve managers is Didier Borowski, Head of Macro Policy Research at Amundi Institute. Thank you for joining us to go through these findings. Just a bit of housekeeping before we get into the bulk of the discussion. So we like to keep these panels as interactive as possible with the audience. So please submit any questions you have to the panel in the Slido box, which is should be online beside the video here. And I'll pose as many as I can to our panelists during this discussion. I want to start on some of the findings we've got on the macroeconomic overview. So as my colleague Taylor mentioned, one of the key findings is that inflation fears are just as high as they were a year ago. 85% of reserve managers have it in their top 3 concerns over the next 1 to 2 years, which is bigger than any other factor. And Kash, I'd like to come to you for this to start with. Does that resonate with you? Is inflation, global inflation dynamics, is that still the big macroeconomic factor that you're most concerned about, or is there anything else that's top of your list of concerns?
Hello, good evening from Manila, and good morning and good afternoon to the rest of those of us who are listening in. Thank you for that question, Nikhil. The results actually resonate quite soundly with me, because if inflation is the foremost concern, it also means that we are also concerned about how this will translate to monetary policy action. And as you know, if you are a bond investor, you're very much beholden to what the central banks would do, because this would affect asset prices later on, and this would also affect the transmission, how the transmission of that would flow into the economy. So aside from inflation, I think another concern would be geopolitics. And I note that in your results, in your survey results, this has decreased in 2022, but is like a longer term concern. And I would like to hear from my co-panelists if it's the same, because I think that geopolitics becomes a longer term concern depending on what you are looking at right now. So for example, if you had asked me that question, and this is my personal view, if you had asked me that question last February, when we were just beginning to see the conflict in Russia and Ukraine, I would say that this is a concern. But had you asked me in September, for example, or December, then my concern would have shifted to the way the central banks, global central banks, have been aggressively tightening their monetary policy. And then if you ask me again this morning, because I read the news about what happened during the weekend, I would say that this is now in my topmost concern. So I guess geopolitics would always be at the back of our heads, something that is always there. But as a reserve manager, or at least for me, it would be really hard to act on those geopolitical concerns. But you know that it would have an impact on volatility. And this is how you would perhaps act on that, with the way that you would trade on that volatility.
Thank you. I just wanted to follow up on that. You of course mentioned Russia, Ukraine, which is, I'm sure, as you mentioned, at the forefront of many people's minds, particularly this week. Do you also think of geopolitical concerns in terms of US and China and the potential decoupling of the financial system in that sense, or the global economy?
I think this is still a question for me, Nikhil. Right?
Yeah, sorry, I should have mentioned.
Yeah.
Yes, back to you, Kash.
Yes, of course. When we think of geopolitics, I mean, very broad strokes, it would always have US-China tensions. And this is not new. In 2016, of course, we were all fascinated with the developments in the trade war. And then you always have geopolitical tensions, US-China geopolitical tensions, as this is one of the major market movers. So this is something that we look at.
Yeah, thank you. Reza, I wanted to come to you next on this. So yeah, we've heard global inflation, geopolitics is a big concern. From one of the findings, it's that many more are fearful of a global economic slowdown, and there's almost 40% expect a global recession too. Where are you on this? What do you think is the biggest concern right now?
Okay, so I just want to build on what Kash mentioned just now. I think we are a bit more diversified. So when it comes to the risks when we construct the benchmark, I think one of the key issues is when diversification doesn't work. For example, in a situation where it's the risk of, like, as per the finding, risk of a stagflation, for instance. As an example, when both bonds and equities are moving in the same direction, in which if they both rally, then it's good. But in this case, when they are both selling off, so if that is the expectation, then how do you sort of like optimize your asset allocation? So I think that's one of the key things that we look at. I think, and also from an emerging market perspective, you have to also tilt towards liquidity as well. So just to share with the panel and everyone's on the channel, for us, our reserves management are guided by the three key principles, which is the liquidity, capital preservation, and reasonable return. I think this is nothing new, but this sort of like principles switch based on the context. Like for instance, your first finding in which many of the central banks experience a dip in reserves. So when your reserves dipped, you can't be as adventurous as when your reserves are actually flushed. So those are the kind of trade-offs that you face when you construct a benchmark. Now, once you've constructed that benchmark, now how you react to it, because we manage against it actively. So to rein it back to some of these issues, then comes the issue of timing as well. Like for instance, right now, I mean, very much early in the year, we thought a recession is coming, but the yields keep spiking up, and central bank seems to not be able to curb inflation just yet. And I think it's pretty much a broad-based sort of like view that the recession could be soft, or it's a soft landing, but the risk is, what if it's not? So those are the key things that I think sort of like a bit of a challenge for me and my team at this point. Yeah.
Yeah, just one quick follow-up on that. So it's interesting that you mentioned that it's a mix between liquidity and capital preservation as to what's the primary objective, and that being dynamic. Where are you at right now then? Where do you see as the priority?
Tough question, but I would say given the landscape, it's relative to before, we are a bit more liquid now.
Okay.
Yeah. So it's relative, right? So if because we recently did a refresh on our benchmark, so I think net I think we are a bit more liquid as compared to before. Yeah.
Okay, thank you. I think we'll come on to a bit more detail on asset allocation and what you mentioned between bonds and equities in a bit. Julius, I want to come to you next, particularly on this point on geopolitics, which was mentioned by Cash, and particularly in light of the Russian-Ukraine conflict, which Poland, I suspect, is more vulnerable than most to that situation. Is that a big factor that's affecting your approach to reserve management?
Hi, everyone. Thanks, Nikhil. No, not really. I can't say that it is. I think I can't remember. Actually, I was trying to remember what we reported in your survey, what answers we gave, and I couldn't. But I would say of the two, I would say maybe inflation is more important, actually. And actually, you know, now that I think of it, I would say, you know, inflation is still a problem, or remains a problem, but I would say maybe for different reasons than at the time of writing the report and compiling our answers. Then we were still, you know, before the peak. So there was a lot of uncertainty as to how high inflation might go, and what central banks would ultimately do about it. Now I would say headline inflation at least across advanced economies, has dropped, and the worst is probably behind us. But core inflation, you know, as somebody mentioned, remains high. Actually, it's even risen somewhat, and this suggests to me that disinflation is not a done deal at all. So we might have, you know, succeeded in bringing inflation from double-digit levels to single-digit levels, but we're not on target yet. And I think you know, a useful historical analogy here is the 1970s. You know, because if you think about the scale and breadth of the price increases and also their common origin being in the energy prices. So now if we look at the price dynamics in the 70s, we see that inflation, not just in the US, but actually across the DM space, did not immediately come down by as much as it had increased. And, it sort of plateaued at a semi-permanently high level. So of course, history doesn't repeat itself. We all know that, but as the adage goes, it rhymes exactly. Yeah. And so we might be seeing something similar this time around. And I would say, there's probably a lot we could talk about the justification for it, but I would maybe just jump right into what I see as the investment implication.
If we actually just put a pause on that for a second, we'll come on to the asset allocation. Yeah. I think this would be a good time to bring in Didier on that, particularly as Julius mentioned, disinflation is not a done deal. Where do you see the global inflation outlook?
So for the global inflation, that's true that headline inflation has peaked, but basically I fully agree with what was just said. Basically, core inflation is likely to prove stickier than many people believe. The point is that if core inflation is sticky, it's also due to the fact that productivity is quite low by historical standards, and it has clearly surprised on the downside almost everywhere. So headline inflation is decelerating, but basically when it comes to core inflation, the best proxy of core inflation is unit labor costs. And you have on the one hand wages that have increased. You don't have an outright wage price parallel like in the 70s, but basically wages have increased. And in some European countries, you have this wage price parallel, like in Belgium, for instance. And in addition, you have very low productivity gains. And unit labor costs tend to impact core inflation with a lag. And basically, that's why central banks, the ECB, the United States are still worried, despite the fact that the good news is clearly that energy prices have come down, headline inflation has already peaked, etc. But you may have inflation may prove more deeply anchored than many expect, and as a result of that, central banks will be very, very cautious. The priority for central banks remain to anchor inflation expectations. I mean, if you have a small recession in the United States, it's what we expect in the United States. The Fed is not likely to cut rates for that. The Fed will want to see disinflation before cutting rates next year, and disinflation on core inflation metrics. And the same is true in Europe, where the ECB is lagging. So basically, central banks are going to be much more reactive than proactive in this cycle. So it's a very different reaction function from the past decade. So what we believe is that we have entered clearly in an environment that will prove more inflationary. That being said, core inflation is likely to decelerate by the end of 2024, early 2025. And so we believe also that central banks have almost reached their terminal rates. We can argue what the terminal rate is in the United States, in the Eurozone. We believe it's 5.25 in the United States, 3.75 in the Eurozone. But basically, we can argue that basically we are close to the end of the tightening cycle.
Okay. I'll come back, Didier, just to come back on what the implications are for the growth outlook. I think Julius, you wanted to come in on that earlier point.
No, I just wanted to support Didier actually, and just say that one other argument I think that it makes the current situation different to what it was in the 1970s, with some implications for central banks, is the role of services, right? So Didier mentioned unit labor costs and productivity. I would throw in increasing shift towards services, and we know that services inflation is slightly more persistent because of the higher share of labor costs as compared to, say, manufacturing, and this makes labor market outcomes central to inflation outcome, and labor market remains quite strong, despite some cooling. So I do agree that central banks cannot just declare, mission accomplished and reverse course. They're likely. I mean, I don't know, but ultimately, I think reining in inflation might require triggering a recession, and then
you're taking the words out of my mouth as to what my next question was going to be. Maybe I can throw that back to you, Didier, as to whether that's that's what you see. Do you see a hard landing as central banks try and get inflation down?
No, as I said, we are almost done regarding monetary policies. It's already priced in. The big shock occurred last year on fixed income markets, etc., and on central banks. There is no big shock to expect coming from central banks. That being said, clearly the tightening in financing conditions will start to have an impact on domestic demand in advanced economies in the second half of this year in the United States and in Europe. We expect a small recession in the United States, that by nowhere a hard landing. You have still macro financial risk from a pure economic standpoint. There is no reason to see, with the job market that remains quite strong, to see a recession. That being said, tighter financing conditions will exert, a pressure on leveraged companies, and that's a key risk, I would say, looking ahead to monitor in this environment. I think something which is important, and in Europe we don't expect a recession, but we really believe that GDP growth is going to be very sluggish by historical standards. I mean, 0.5, 0.6% next year, far below potential growth, both in the United States and in Europe. And the UK is a case apart. I mean, the UK economy is trapped in a stagflationary environment. That being said, at a global level, I think it's very important to mention the big divergences between some large emerging economies and advanced economies. And for instance, you have some key emerging economies that are doing well in terms of growth and that are expected to do well next year, even if they are going to decelerate somewhat. I'm talking about India, Indonesia, etc. China, it's another story. I mean, but basically we do believe that the authorities will continue to implement some measures in order to stabilize their economy. They have the means to do so. And we believe that the growth gap will continue to be to favor emerging markets. And that's a very important point, because basically it means that the center of gravity of the global economy that has started to move towards the east, I would say 20 to 30 years ago, and will continue to move towards the east. The growth gap is definitely in favor of some key emerging markets, not only next year, but probably in the coming decade. And potential growth, even if it's going to slow in emerging countries, it will remain quite much higher than in advanced economies. And it has consequences in terms, we believe, in terms of asset allocation. And when it comes to inflation, I mean, stagflationary pressure are there in advanced economies, Europe, in the United States, but you don't have stagflationary pressure in emerging markets. Inflation has peaked. Some central banks are ready to cut rates in Latin America. Look at what's going on in China. So I think it's very important to look at the global situation, but also to monitor the situation on a country-by-country basis, in particular in emerging markets.
Thank you. I think that's a good segue into maybe bringing cash back into this conversation about emerging markets and being cognizant of the differences between US, Europe, and particularly those in Asia. Are you optimistic that from a reserve management point of view, at least, that stronger growth in parts of Asia will help alleviate some of the stresses that were seen in markets last year?
Well,
this was back to Cash, sorry.
Oh, sorry.
I'll come back to you in a second.
Yeah. Thank you, Nikhil, for bringing this question back to me. I think it's a very interesting question, because you can see growths in some pockets of Asia, and that growth is relative to the developed economies. So I think yes, but to a very limited extent. And Asian markets it's not something that I look at every day, because I manage a global bond portfolio. But where we do see it is in the optimism in some of our neighbors and the developments. In some of our neighbors, you can see it sometimes in their FX or in their bond markets. But this is not something that I look at on a daily basis, unfortunately.
Okay, thank you. I'd like to bring in Reza back into this conversation and moving the conversation along to asset allocation implications of what we've just discussed here. I'm particularly interested in what you mentioned about the correlations between bonds and equities and plans for diversification. In the current market and economic backdrop, are you still looking to diversify your portfolios, or is it, as we saw in the key findings earlier, that many reserve managers are looking to move back into traditional reserve assets like bonds and gold?
Yeah, but before I answer that question, I just would like to quickly touch on the previous question about the fundamentals in Egypt. I think what's happening now, I think for reserve managers, when we look at the market, there's always something that is, as a bearing of the market. When everything is good, then you look at the fundamentals. But right now, while I think the emerging markets, especially within Asia, ASEAN especially, I think while we still have strong fundamentals, for instance, we have young population, growth is still strong. But what is key right now is the interest rate differential between countries. So that is becoming more of that is being given more of an attention rather than these fundamentals. So I think, just want to comment a bit on what Didier mentioned. As we cross this terminal rate, which we think that it might be closing in, I think then the market will start to focus back on which market has better fundamentals. As of now, I don't think it matters at this point, because these uncertainties is something that is a key focus. Now, I will jump back to your question. This uncertainty will lead you to make these decisions about diversification. I think the point of diversifying to your investment is whether or not it improves your risk-adjusted return, right?
Yeah.
I mean, that's the basic. So for us, for as long as it does that, then we will continue to diversify. I think, but still, again, when I mentioned earlier, we focus more on liquidity. I think we still continue to look into that, because it's a big factor that we look at, because whenever we introduce, we've seen it based on experience. We've seen it in the past when we, for example, we started equity when it was a low yield environment for almost a decade, and it worked, right? So that has helped. And then I'll touch a bit on dollar. So the construction of the benchmark has always been a view of how much do we diversify away from the dominance of dollar. So in short, yes, it's clear we need to diversify, but the range or the context might be different depending on what sort of landscape we are looking at.
Sure. Just a quick follow-up on that. So you mentioned, if you think the terminal rate in terminal policy rates is approaching, and I guess if the shift to equities was driven partly in a low yield environment, now bonds are offering. Do you think bonds are offering relatively attractive yields for you to move back in?
I saw that coming. Which is why I said I think it's a tough call at this point, because I think even if equities were to rally, there will be a bifurcation happening within that index. I don't think returns would be as high, which is why it requires you to be more agile, which means that you need to trade the market. Second is you need to select which stock are you playing in. I think if you look across markets, I think again you have to diversify as well. Like for instance, some of the more tech-driven market, you need to buffer it with some of the more traditional index, as an example, and then you need to be able to be agile in allocating between the two, because those two sort of like benefits from that. So again, in short, I think as we approach terminal rate, there is an upside for equity, but we are going through a recession, so that is another headache. But we are going through a shallow recession, which is a bad, which means that it could be positive for equity, but clear cut earning your EPS might not be as stellar as before.
Yeah.
You need to be more selective, and timing matters. Timing is because if you look at the market now, I'm not sure whether, I mean, personal view, I'm not sure whether right now it's a good time to go in, or do you wait? So that to me is something that we look at that's my headache on a daily basis.
Definitely don't envy reserve managers in this environment. Didier, I think this would be a good point to bring you back in on that point on fixed income and equity. Where do you see the outlook for these two asset classes in particular?
So clearly, regarding, I mean, as a consequence of what I just said, for the macro backdrop, we are underweight the global equity markets. We believe that corporate margins will be under pressure. We can't rule out a profit recession in some parts of the US equity markets. So we need to be very careful when it comes to the exposure to global equity markets. And it was our mantra, I would say, since last October, bonds are back. And that's still true. I mean, thanks to higher interest rates, we do believe that we need to be more exposed on bond markets. So that being said, bond picking is very important. Bond selection is very important. So we like government bond markets clearly as an edge because, as you said, the correlation has changed. I mean, and this is a great return in diversified portfolios of the 60-40 approach. Meaning that basically if you have a correction on equity markets as a result of this global economic slowdown or as a result of a small recession in the United States, basically the long end of the curve in Europe and in the United States is going to benefit from that. And that's a very big difference with what occurred for sure last year. And that's why I think it's important not only as a hedging policy, but also to improve, in fact, the return of the portfolio. And we increasingly consider our exposure to emerging markets, both in local currency and in hard currency. And that's an important point to mention. We do believe that central banks are going to cut rates. They will definitely offer some value on fixed income markets. And we like also, but it's in the short term, like the exposure to cash, because basically for all the investors that are that want to wait and see, given the uncertainties that we mentioned regarding, I would say, the growth outlook, inflation, geopolitical uncertainties, well, many investors are back on cash. That's very true in the United States. That's also true in Europe. And we believe that it's probably going to stay like that, at least in the coming months. And they will redeploy their portfolio toward riskier assets, but later in this cycle, when the global macro situation will clarify. I just want to say an additional point regarding what was said regarding the geopolitical factors. Because basically, with geopolitical factors, you have a new form of globalization that has emerged. I mean, it's not only about nearshoring due to the carbon footprint. It's also related to friendshoring. Basically, a new concept that has emerged, and when you need to locate your production process in countries that share your values, and at the end of the day, that's something that is very important because it's a great return of geographical diversification. At the end of the day. And with this great return of geographical diversification, there is also an impact probably on inflation. This is probably the end of what I would call the great globalization that took place, I would say, between the mid-80s until the recent period. Basically, globalization is no longer to prove disinflationary. So my point is that geopolitical concerns have an impact on globalization, and they will have also, to some extent, an impact on inflation. And that's something to consider also when you allocate money to emerging markets.
Yeah, thank you. Yeah, that's an interesting point about how all of these factors are, I guess, intrinsically linked. Julius, I want to come to you on firstly, if you have any response to what's been mentioned on asset allocation, but also your thoughts on one asset which hasn't been mentioned yet, which is gold. We saw a record number of central bank purchases of gold last year, and for the National Bank of Poland, I think it's added to your gold holdings in recent months as well. And what your thought process was there as well.
Sure. So let me see on asset allocation in general. Well, I think it was Didier who said that fixed income was back in town. Couldn't agree.
Back, I think it was.
Yeah. Okay. Couldn't agree more, especially in the euro area. So just to give you an example, just peek behind the curtain. In 2020, when we reviewed our strategic asset allocation in 2021, we went through our usual round of capital markets assumptions and modeling. And if I recall correctly, the 5-year expected return for our Euro portfolio was fixed income portfolio was about negative 0.20%, so something like that. So now it's at 240 in the most recent round. So this is a completely new scenario, and bonds are no longer a ballast in your portfolio, but just a steady source of income that can be acquired at quite attractive valuations, I should say. What this means, however, is so this more favorable environment for fixed income, I think, ushers in a somewhat more challenging environment for diversification. Because I mean, just prepping for today's call, I know I looked through the markets, and here's the most recent data for real estate cap rates. So not net operating income on real estate, starting from the most alternative asset class, at least by central banking standards. That's in the 5% range. 12-month forward earnings yield for S&P 500, which some proxy for income, about 5.2%. Yields on investment grade credit. And again, I'm looking at the corporate sleeve of the Bloomberg Barclays US Ag Index. That's 5.4%. And now wait for it, 3-month US Treasury bill, 5.25%. So if you can get 5% on cash, why look for non-traditional assets, right? I mean, I've purposefully framed it in such let's say in such a way, but and I know and acknowledge that the reality is more complex. You have big dispersion between quality. If if you look at earnings yield across S&P 500, there are big disparities there, from like 15% to 2%. But so I wouldn't say it's a game over for diversification, but echoing Reza, I think it's certainly going to be more challenging to find diversifiers that work, especially in view of the positive correlation between stocks and bonds, also likely ushered in by central bank tightening and the pursuit to bring inflation back to targets. Now, turning to gold, that's a tricky one. So, gold has very low real returns. So it's if you go back to mid 1970s, that's about 1.5% annualized. So that's that's about half of what you would get in U.S. Treasuries medium term, and 5 times less than on equities. And the reason, of course, is that you don't clip any coupons. You don't get any income on gold. This is nothing new and well recognized. Reserve managers have historically been drawn to gold, not because it offers huge return potential, but because it is a useful hedge in some unfavorable outcomes, market outcomes. I would say this statement needs some nuance, because when you actually look at the numbers, gold proves to be a good hedge over the long run, not so much over the short run. So if you actually look at monthly data, monthly horizons, then I think historically, again, in this time frame going back to 1970s, gold hedged only about 50% of bet equity market outcomes, about half. Extending this horizon does improve that hedging power quite substantially. But I should mention that the reason, the hedging potential depends on what you're trying to hedge. If your main asset class is equities, then you're going to worry about how good gold is as a hedge against equity drawdowns. But for us, we have a huge, and I think that that echoes something that Reza has mentioned. We always think in terms of our largest allocation, and our largest allocation is to US dollar. Yeah. And somewhat surprisingly, or maybe surprisingly or not, I don't know, gold hedges the FX risk of the US dollar quite effectively. It has statistically significant negative correlation to USD. So if you have most of your allocation to USD, that's a favorable pattern. And lastly, I would say that for reserve managers, I think it may not just be about the price patterns and price relationships. Gold has historically been the pillar of the world monetary system, and perhaps that's water under the bridge. And we're in a completely new digital environment. But actually, as our financial systems become ever more concentrated on digital assets, well, perhaps it is reassuring to have at least some allocation to an asset that retains, its function as medium of exchange, even if the internet gets turned off. Not that I expect it to happen, but there it is.
That's one phrase I didn't think I'd be hearing in this discussion about whether the internet will be turned off. But no, I appreciate your insights there. That's very useful. I wanted to bring Cash back in on some of these points that we've heard, particularly on the point of currencies and the dollar. I suspect it's a similar case with the Central Bank of Philippines, with much of its assets denominated in, or foreign assets denominated in dollars. How are you looking at some of the currency either hedging or the currency diversification plans going forward? And do you still expect the dollar to play a predominant role in your reserves?
I think Mark articulated it very, very well during the start of this conference. And he mentioned something about the dominance of the dollar with respect to size, to the depth of the market, to the liquidity of the market, and the convertibility of the currency. And if you have reserves to deploy, where else would you go? You have all of these characteristics that you are looking for in a reserve asset. Like Reza mentioned, they are concerned about liquidity. And if you are in the dollar, then, or if you are in US treasuries, then this is a very liquid market. It's very easy to churn. It's very easy to buy. So I guess the answer to that question is yes, and the data already shows that we do have a sizable portion in US dollar. And with respect to the other currencies that you mentioned, the renminbi and the euro, we do have small percentages of this in our reserves. And when we look at the total currency mix, we do think about the diversification effects that this would bring, not just from the currency, but also from the interest rate risk and the FX risk that it has. Mm-hmm. So we would still take a look at that.
So it's still very much a dollar dominant story there. Is that similar in your case, Reza, and for Bank Negara Malaysia?
Well, it's hard to find an argument against dollar at this point. I think that's just my view. But I also want to provide an observation, right? So whenever there is crisis, the dominance of dollar becomes even more intense. As an example, right? When we went through COVID, if you can recall, the market was so short of dollar that it went really crazy for like, I don't know, it went into frenzy for like, I was in the intervention desk at that point, and I was monitoring market where everyone's scrambling for dollar until the dollar swap lines were provided. You see that's just an example on how it is hard to find an argument to say that, oh, the dominance of dollar will wane. I mean, of course it will or it will not, but you would put that in a super long-term scenario, unless if another market is big enough or they liberalize the market as much as the dollar. But the way I see it now, I think in the next crisis, if ever there's next crisis, you will see the dominance of dollar will increase even more because people need dollar. Whether or not it's good or bad, I would not want to discuss it here. It's just how the system is right now. It's the system, right? It's like when the machine is all by dollar, if it doesn't move, it needs more dollar. So that's how it is right now. So the way, as a reserve manager, the way I see it is purely from sort of like a mathematical standpoint. What is the expectation of dollar returns, and what would be the volatility, and then we optimize it, and then we have an overlay on how big thematic sort of like switch into some of the currencies would be at play. But typically, if you are in a benchmark of within 3 to 5 years, when you do a refresher, it's quite hard to factor in this into your sort of like construction of the benchmark. It is something that is, like as an example, we've talked about China pre-COVID. I think pre-COVID it was looking quite okay. It was and then we also still look into the narrative of its structural reforms, and then how China wants to sort of like remodel itself into a consumption-led economy. But there's still a lot of grounds to cover. So it's something that we monitor, but it's not like a big sort of theme that we say that the dominance of one currency is affected by another currency at this point, just yet. But I wouldn't necessarily disagree with the finding. I think it's really obvious. It will wane somehow to a certain extent, but
So
I don't see it yet. Yeah. So in short, yeah.
Yeah, thank you. I want to bring it maybe more to the near-term perspective. And one of the findings we have is that the euro has seen most demand from reserve managers over the next 12 to 24 months. And I think that relates to what you mentioned as well, that they're offering higher yields and it's no longer negative, I suppose. Is that one big factor as to which may be drawing you towards the euro, at least in the near term?
Well, that's certainly a factor, yes. I mean, for a long time, we've been. I mean, it's been sort of a tough call, and if you look at the currency structure of our foreign reserves, it's quite unusual for a European central bank because our biggest allocation is to US dollar. I mean, most European central banks will have most of the reserves in euros. We've not we've decided against that because there was some concern among our senior managers, the board, that negative yields are incompatible with capital preservation, which is our fundamental concern, or falls within our fundamental mandate, if you will. So we've diversified away out of euro, and well, we've looked at currencies that behave like euro but have maybe a higher, somewhat high return, or don't have such negative yields, or negative yields at all. And now the tide is turning. The tide is turning, right? And so it's definitely an attractive proposition, because the euro zloty is the least volatile cross for us. So the least volatile cross among all our currencies in our reserves portfolio is to euro. So euro is so it's definitely an attractive proposition now that the yields have come up.
Yeah. Thank you. Didier, that's a good point to bring you back in as to where do you see the outlook for the euro and also, I guess, the dollar more generally next year or so, maybe?
Yes, I fully agree with what was said. The dollar is likely to remain the predominant currency at a global level, but because simply there is no alternative. That being said, it does not mean that the dollar will stay as strong as it is today. And basically, we see new opportunities in the FX space on the euro for sure, because in fact, when you really look at the relative monetary policy cycle, it tends to play in favor of euro assets. When you look also at some emerging markets, we do believe that certain currencies in emerging markets are still undervalued and are likely to reappreciate somewhat versus the US dollar. And so we must disentangle, I would say, the idea that the dollar will stay the predominant currency with the idea that the dollar should stay strong. As long as you don't have a broad financial crisis or a systemic risk, the dollar can depreciate as a result of the recession that is likely to come in the coming 6 to 9 months. And that's a gradual depreciation. And that clearly, regarding the euro, we do believe that the worst is over. And the euro suffered from this energy shock. And looking ahead, we do believe that the euro will regain some of the lost ground. So we are mildly positive regarding the euro, but once again, it's not only about the euro that we're positive. We are also positive on certain emerging currencies, and we do believe that the dollar is likely to depreciate on a trade-weighted basis at the 12 months horizon.
Okay, thank you. Just before I continue, I'd just like to remind the audience that to please keep submitting your questions. We have 15 minutes left for this session where I can post the questions to our panel. There's one that we received earlier on the types of products that reserve managers are using, in particular use of passive and index products like ETFs. Is that something that you're already implementing or looking to implement more? Reza, I'll come to you on that one first.
Because we've started our investment into equity quite a while back. I think naturally ETF is one of the tools that you have either to get a quick access into a market where you may not have a specific view on stock selection, for instance. Because I think one of the strengths of central bank, I think again is my view, is you are good at asset allocating rather than stock picking. So when you are good with a cycle, you tend to be able to pick which index that can be beneficial, and then this can be something that you can look at when it comes to ETF. I think it is a tool. It is a tool that we've used, and it is a tool that we will continue to use. I think, and I guess again, it would be a tool that is useful for any central bank who wants to start their investment into such asset class. So I guess it's less of a headache rather than But again, one of the challenges would be, I think, in my experience, if you're dealing with your stakeholders, is actually the ability to understand what's inside the ETF, because that could lead to another complication as well. Because sometimes you may like, I don't know, 199 stocks in it, but you don't like 2 stocks in it. So, for example, right? So that is an example of a challenge that we've faced in the past.
Yeah.
But other than that, yes, it's a tool, and then we find it useful. Yeah.
So same question to you, Kash. How are you using ETFs, or what are your thoughts on that?
For us, we don't invest in equity, so we also don't use ETFs.
Okay. And Yulia, same question on your side?
Well, we've been using equity index futures to gain equity exposure for the past couple of years, and now we're looking into launching an ETFs portfolio. We're in discussions. We're having internal discussions about this right now. So there are plans of launching ETFs, but so far we've been using equity index futures.
Okay. I suppose jumping on from that, it was mentioned that ETFs could be used for, I guess, diversifying or going into new asset classes like equities. Another new asset class that we consider in the report is ESG assets and sustainability, which is starting to come onto the agenda more and more for reserve managers to consider. We see that green bonds are by far and away the sustainable asset with most in demand right now, more so than say social bonds and even sustainable ETFs, for example. Maybe staying with you on this one, Julius, how are you considering ESG practices or ESG assets on the reserve management side?
So the main pillar of ESG integration with our reserve management framework is the green bond strategy. And broadly speaking, it consists in building and maintaining an allocation to green bonds that roughly reflects the share of green bond universe in the broader investment grade fixed income universe. So the green bond portfolio is currently about 1 billion plus euro, spread across a number of currencies like euro, US dollar, sterling, CAD, and even Australian dollar. And it's mostly concentrated in agencies, SSAs, and governments. Yeah, so that's the pillar of the strategy. I could go on and say, just a couple of things about, let's say, experience and challenges.
Yeah, I was going to follow up on that.
All right.
Yeah,
So
actually, if you could, yeah, what is the biggest hurdle to further adoption then?
Right. So I think there's a lot of talk about size and markets, size and liquidity issues. In fact, we haven't felt that to be a showstopper, or haven't felt that to be particularly problematic. So we haven't faced major headwinds in building the portfolio. And in fact, I think the market itself has evolved tremendously, and now when you look at some green bond indexes, you'll find, some pockets of the market, you'll find 70, 80% of net issuance coming in green bonds. So that's a remarkable new pattern, something completely new, and attests to growth of the market. I would say maybe in terms of challenges, I would say maybe pinpointing impact and avoiding greenwashing is definitely something that we think about. So in theory, green boards are structured in a way to ensure accountability because it's a use of proceeds instrument. So in theory, specifically, or you should know where your money is going. And arguably, a lot of work has been done to make the market more transparent through the new taxonomies, and there's obviously the third-party verification that you can resort to, and that's also helpful. But I think, on a more fundamental level, there's no escaping the fact that the green label is essentially binary. Either something is green or isn't green, and there's no distinction between the validity of a project or its greenness. And even more importantly, perhaps, the green bond itself focuses on specific projects referenced in the prospectus and not so much on the issuer's broader operations.
Yeah.
So someone could be acquiring funding under the guise of green label, and this could be just a box ticking exercise without a desire to engineer meaningful change. So, and one example that I often give, not that I've seen it, but one example that I often give is, there is definitely a difference between an energy company which uses green bonds to, let's say, diversify away from coal and towards renewable sources, and one which uses the funding to install, let's say, wind turbines on its oil platform or solar-powered flaring valves. It's a difference, but it can be the same green bond. So,
yeah.
But in the latter case, you would say that issuing green bonds is simply a way of requiring relatively cheap funding to support current business, and not necessarily part of a broader strategy to transition away out of fossil fuels. So I think this should be called out as greenwashing, and I think because it's actually quite difficult to establish these facts. I think it can be a challenge, and ESG scores are not particularly helpful either, because if you look at There was
I think we're just conscious of time there, but
sorry.
Sure. Thank you on that. I was just going to say, we through our OMFIF Sustainable Policy Institute, we do a lot of work in this area, and time and again, greenwashing is mentioned. Just coming to Reds on the same question as to how how you're considering the topic of ESG, implementing it, and also what the potential hurdles are.
Yeah. Well, I mean, I've mentioned earlier, we've reviewed our sort of strategic asset allocation. I think the way we do it is we integrate it into our sort of like the entire benchmark. So it's a constraint that we apply on the asset classes before we do a mean variance optimization. So again, I think that's a technical side of it. But again, I think the challenge, I would like to echo what Julius mentioned, because there, obviously there's trade-off when it comes to investing into ESG, right? And that's one of it is risk return, whether or not it's marginal or not, and then it depends. And then whether or not, if you put money into ESG, it becomes what's mentioned by Julius, what is the big outcome that you want, right? You don't want to sacrifice a certain aspect of what your investment objective is and put into something that is unproductive, right, for example. But again, I think greenwashing is a big challenge, because on our side, I don't have the resources to actually go and do audit on those projects, right? And then we have to rely on third party, for instance, the index. So those are the kind of challenges that we're still trying to sort out. But again, I think the push towards ESG or impact investing in this case is quite strong. I think it will stay, because we believe that it's also part of the structural change that is happening around the world. For instance, climate is actually affecting how inflation works. I think as a central bank, you pay attention to that as well. So these principles have to be in line. So again, I think, yes, we are there for we will continue to improve our ESG approach pragmatically. So yeah, I can add to that.
That echoes some of the findings we've got in our report. Both we have a chapter dedicated to ESG, and also on operating models and data. And an increasing share of reserve managers are using external managers for sustainable assets, I suspect, for the reasons that you've just mentioned there, that it's quite onerous to understand the landscape. I want to bring in Cash on that same point as to whether ESG is becoming a focus at the Central Bank of Philippines, and perhaps even on just the thoughts on climate change more broadly, and whether that's something that you're becoming increasingly wary of.
So for the BSP, it has been identified as one of the strategic thrusts. So Sustainable Banking, they launched it as a strategic thrust for the coming years. And the ambition is to be an internationally recognized central bank that advocates green and sustainable policies. But from a reserve management perspective, I would say we started a bit earlier than the bank-wide thrust of sustainable central banking. And we got our feet wet by investing in green bond funds of the BIS. So from the time that we invested in this, the size of our investment has grown about 3 times already. And we are still in the very nascent stages of incorporating sustainability principles in our internal portfolios. But we do have a lot of discussions with our peers on how to do this. We want to be able to take into consideration ESG in our portfolio management and our risk management. And we also are working towards becoming a signatory to the UNPRI, the Principles of Responsible Investment.
Thank you. We have time, Didier, just for 1 minute, a quick comment on how your thoughts are on ESG or climate change more generally.
Well, something important to mention is that even though global investment in the energy transition have increased very significantly over the past years, there remain a tiny share of the investments that are needed in the coming decade. So we really believe that ESG products are going to, and green bonds in particular, are going to experience a bright future. And as you probably know, I mean, ESG is a cornerstone of our approach in Amundi. And clearly all our portfolios are ESG compliant. So basically, we do believe that investors at a global level will increase their demand for ESG products and for green bonds. Just have a look to what is needed to achieve the energy transition in the coming decade. That's enormous, and I believe that it's only the start of this greenization, I would say, of global portfolios.
Thank you. Unfortunately, we will have to leave it there. I'm sure we could go on for, well, I personally would love to go on for a lot longer. There's been so many interesting points raised across the four of you. Yeah, I'd like to thank Didier, Julius, Reza, and Cash for your useful insights on this discussion. And for the audience, I'd encourage you to download the report where we go into a lot of these discussion points on the macroeconomic overview, asset allocation, currency decisions, and ESG that the panelists touched on. We go into it in some detail. And to also look ahead to the Global Public Pension report that will be coming out later this year, where we also touch on similar themes applied to pension funds and sovereign funds. And we'd like to, I'm sure they will explore how the differences are between the reserve managers and how other public funds are approaching these topics. So with that, once again, thank you to the panel, and I will hand over to David Marsh to give some closing remarks.
Yeah, thanks very much, Nikhil, and thank you, panelists, Cash and Reza and Didier, for taking us through that. And as you said, Nikhil, we could have gone on for a bit longer, and indeed you are able to go on, aren't you? I think you're going to be doing a few road shows in coming weeks with people. So if anybody is tuning in here and you think you'd like to know a bit more about this report and quiz the people who did the research a bit more, please do get in touch with us and do try to follow up in that way. This has been going for 10 years now. I think this is the most granular that we've had up to now. It really has been a great work. I'd like to thank also at this juncture people, some of whom have been with us right from the very beginning, State Street and DZ Bank, as Frank Scheidig said, he's been there right from the very beginning, and Amundi, our old friend Didier, who was on the final panel. Now, there's 6 points I'd like to make, just really to give you something to go home with at the end of this session. One is this idea about stagflation. Now, that's the same as inflation, only it's worse because it comes with low growth. As was said, we're close to the terminal point now. I think the central banks have more or less given up on the idea of getting back to 2%. That was all more or less said in our survey. I think it's going to be 3 to 4%, something like that, for several years to come. And that's not really the end of the world. Central banks are going to be very pragmatic, and they know they're going to be run out of town if they try to be too diabolical on all this. The second point about fixed income, it has made a comeback. You don't have to be all that clever now just to go into fixed income markets. That could, of course, help the euro. As was said, the euro will go from this negative correlation that we've had, negative yield, that Julius was telling us about, to a positive yield of, say, 2.5%, which is quite something. The third point about diversification, game gets more difficult, particularly if central banks are drawing in their horns and now are trying to take less risk. And that certainly came out of the survey. And you can get a lot in cash these days. The correlation between equities and bonds, of course, is significant here. And as was said by several people, you have to be a bit more adventurous in the equity bottom-up allocation as well as the top-down allocation. That's going to be more difficult. It's going to require more staff and so on. So people who are in equities in the central banks are going to have to hire more staff or get more external managers, one or the other. The fifth point about the fourth point about the renminbi, that's long-term. There is probably very good ground to be made in the renminbi. The Chinese may well benefit from some of these sanctions that have been putting on them, and the CHIPS Act and so on may actually strengthen the chip industry over a long period of time. So it's quite conceivable that short-term, the renminbi might be sailing into troubled water. Longer-term may be a very good bet. Fifth point, I must just mention gold, simply because, as Julius said, if everything else goes haywire, you have that. And we've seen several central banks, we don't need to mention them, there must be 10 or 12 of them over the last year, for different reasons, who've gone into gold. You cannot neglect gold, even though, as was said, the return over a 50-year period may only be 1.5%. a year. And the sixth point to end on is ESG. Since we launched this survey and started doing this body of work 10 years ago, ESG has now entered into the bloodstream. It's not something that you have to explain that much more about. Clearly, the greenwashing aspect becomes more and more difficult over time. We have to look into that. But it is there, part of the central bank's toolkit now, part of their mindset. And this is not going to go away. And I would say that this is actually an indicator of the way the financial markets as a whole are looking at ESG. It's now there across the waterfront. You do know have to be far more discriminatory, far more selective, and far more curious about what you're buying. So on that note of curiosity, please do keep supporting the OMFIF GPI. Please come back, answer our surveys as well, but please also come back and listen to us in various guises as we play this one out in the next few weeks, because we are going to be going around the world with this report, talking to people, telling them about it, and trying to get your responses as well. For next year's GPI, we mustn't give ourselves now a pat on the back and simply say we're going to relax. We have to start thinking about next year's survey. So with that in mind, I'm going to say goodbye to all of you. Thank you for listening, and please carry on tuning in to these OMFIF broadcasts on various matters of financial and economic importance.